Are you confused about how much money you should be putting down when you're purchasing a home? Let's explore the difference between a 5% and a 20% down payment and what that actually looks like. I'm going to dive into the advantages and disadvantages of both options and let you make an informed decision based off the information today. Whether you're looking to purchase a new home or you're wanting to be a first-time home buyer or you're just looking for an upgrade of your current place, it's gonna make a difference on whether you're putting a 5% down or 20% down on this new purchase of yours. The goal of this video is to help you make an informed decision and help you maximize your long-term growth in this property so you're making the wisest financial decision today in order to benefit you down the road. Before we jump into the content today, go ahead and hit that subscribe button. It really helps our channel, and please follow along as we continue to provide financial education to Canadians across the country. Now let's jump into the video. Last week, a close friend of mine reached out for information just about purchasing a home. So they're looking to purchase their first home here in BC, and they want to know the benefits, the cons of using 5% down payment versus continuing to save up and reaching that 20% down payment. And they just really wanted to know the pros and cons, the benefits, the downfalls of one option or the other, and if one makes more sense now, or is the other one going to make more sense to do in a year or 2 years when they have that full 20%. Many Canadians in their 20s and 30s and maybe even their 40s are in the same predicament as this couple is because of the rising inflation costs and the rising home costs. My wife and I are actually looking to purchase our first home this fall as well, and so we are seeing the very drastic growth of even townhomes or condos in our area versus what they looked like a year ago or 2 years ago. The crucial question today that I want to answer is whether it makes more sense to purchase a home with 5% down, take on CMHC insurance, and enter the housing market earlier, or continue to save and continue to rent for the next couple of years, hoping that the market doesn't grow drastically between now and when you're looking to purchase, and then purchase with that 20% down payment in a couple of years. So when I look at this scenario, I want to look at basically a base purchase price of $500,000, and we're going to look at that option in both the 5% and the 20% down payment options as far as numbers are concerned. And realistically, $500,000 isn't going to get you a whole lot in the Greater Vancouver area or the Greater Toronto area. You're probably going to be looking at more of a 1-bed, 1-bath, maybe if you're lucky, 2-bed, 1-bath condo. Whereas in other parts of the country, this might actually get you a reasonably sized home that could be newer even. So this video is meant to really reach every province differently depending on what your purchasing power is. But again, I want to focus in on just a solid $500,000 purchase, regardless of what kind of house or property it is. CMHC insurance doesn't change. It doesn't change if you're in BC or Ontario. It only depends on the amount of down payment you have on purchasing your house in Canada. So anything below 20% is going to require you to have CMHC insurance, which is basically insurance to show that you are not going to default on your mortgage. Anything above 20% does not require you to have CMHC insurance. So it's actually going to reduce the overall amount of mortgage that you're going to be paying throughout the entirety of your amortization period. There are other factors to also consider when you're purchasing a home. So you need to consider that interest rates are going to change. It doesn't really depend solely on what's happening now. Yes, that might be more favorable for you, or in the current market, a little less favorable for you. But you need to think about what happens in 3 years or 5 years when your mortgage rate comes to conclusion and you need to renew that. And you also need to consider market stability. Do you strongly believe, or is there strong indicators that the market is going to be growing or staying consistent for the next few years? Or is it going to, again, grow drastically and you want to get in now? So there's many variables when it comes to purchasing a home, and it doesn't solely depend on whether you have a 5% or 20% down payment in place. It really is crucial to analyze all of your financial circumstances and all of your personal goals and wants and needs going forward, because it's going to vary person to person. And one person, it might make sense to have the 5% down payment and take on CMHC insurance. And the other person, it might make more sense to hold off, build up their wealth to that 20% down payment and make that purchase when they feel more comfortable to, or when they are in a better financial position to do so. Now let's look at the two options when it comes to purchasing a home. And keep in mind, I'm going to look at the drastic ends here. So 5% down versus 20% down. Anything below 20%, keep in mind, you still need to have CMHC insurance. It's going to be prorated dependent on how much of a down payment you have, starting again with a 5% as the minimum. So we're going to base off a 5% minimum and then a 20% minimum with no CMHC requirement in place. So let's look at the 5% minimum and what that actually looks like as far as a bit of numbers and also a bit of just logistics in general. So to list a few benefits of only a 5% down payment, obviously you don't need to have as much of a down payment in place. You could have been saving for less or a shorter period of time to build up this 5% amount. You can enter the housing market with a much smaller amount of cash on hand. This really does make home ownership more accessible, especially for first-time home buyers. Again, regardless if you're in your 20s or your 30s or potentially even your 40s or beyond. The next benefit of having 5% only and CMHC insurance is you typically get a lower interest rate when you first apply for your mortgage. So the reason for this is the lenders are going to see that your mortgage is backed by insurance and they're going to give you a more favorable rate. Typically, this is in the range of 0.2% to 0.3% off of what the standard mortgage rates are at that time. This might not seem like a lot, but it will make a difference of a few $100s typically, if not more, depending on your purchase price on a monthly basis or even a bi-weekly basis. So it does add up over the period of the term, so keep that in mind as well, and really bank on or lean on your mortgage broker or whoever's helping you along in this process to fully understand what that looks like. Now, the last benefit I want to look at today is the benefit of home ownership immediately. And so basically, now that you have this 5% down and you're able to purchase into the market, you're able to benefit from the growth that's going to take place. So over the last 2 years, we saw a substantial amount of growth taking place. And if you had waited to build up your 20%, then you wouldn't have been able to benefit from that. But on the flip side, there's going to be circumstances where there could be a market downturn in the housing sector, or it could be the case where we see a crash altogether. There's so many variables when it comes to this, but you really need to make that decision for yourself. When it comes down to it, if you only have 5% down and you do believe or you've seen indicators that the market will continue to grow and grow at a substantial amount, then it probably will make the most sense to purchase with only 5% down payment at that time. Now, to list a couple downfalls with 5% down, you obviously need to pay CMHC insurance. So with 5%, this equates to $19,000, which is going to be based off of $500,000 purchase price, just tacked onto your mortgage amount. So if you only have 5% down, $25,000 down payment, and you have $475 of a mortgage, you need to add the additional CMHC insurance cost, so an additional $19,000 to your actual borrowed amount. The nice thing about this is you don't need to pay this amount initially at the start, such as your down payment, but it is going to be tacked onto your mortgage and you're going to be paying for this with interest over the course of your amortization period, whether it be 20 years, 25 years, 30 years. So as I mentioned, because of the CMHC insurance cost, you're going to have a higher mortgage cost, which again, you're going to be paying interest on it. And that could be quite expensive, especially with the current mortgage rates of well over 5% for a 5-year and a 3-year fixed term. Now let's look at what a 20% traditional down payment looks like and the benefits of this. First off, obviously with 20% down, you're going to have a smaller mortgage amount, meaning that you're going to be paying less mortgage interest over the course of amortization. So obviously for the first term, the 3 or 5 year fixed term or variable rate that you choose, you're going to be paying less in interest over that period because you're going to have a smaller amount that is actually interest owing. Now, simple numbers without doing the whole calculation on the screen here, because of traditional mortgages' ability, or most mortgages' ability in general, to allow prepayments or basically additional payments against your principal amount of debt, you can put up to 15% of the additional mortgage on an annual basis to pay down your debt even quicker. So from the savings, so you'd be paying less on a monthly basis with a higher down payment option because you've borrowed less. You can then take that money and reinvest it or repay back your mortgage amount at a faster rate, which comes to $481 a month in this scenario. You're actually going to be paying down your mortgage quite a bit faster, and then resultingly you're going to be paying much less interest over the course of your entire amortization period. Now, flip side of this, there's obviously always downfalls to every scenario. So you need to have a higher down payment, meaning that you potentially will need to be spending more time saving in order to purchase that first home of yours, whether it's a condo, a townhome, a detached property. It's going to take some time to build up that 20%. So again, in this scenario, $500,000, saving $100,000 for that down payment, that could take someone anywhere from 3 years to 15 years, depending on what their saving habits are. Another downfall to this is by taking that time to save, you're also losing out on the market growth that could be occurring in the short term. So you have to be confident that the market is going to stay relatively stable over the period of your renting state or during the period that you're saving for that down payment. So keep that in mind as well when it comes to this traditional mortgage amount. There's really no right or wrong decision when it comes to a 20% or a 5% or 10% or 15% down payment amount. It really comes down to your confidence level and what you're confidently and comfortably sitting with when it enters home ownership. Both options take risk. Both options require you to make personal assumptions. So don't make this decision lightly. Don't rush into anything without fully considering what could take place and what you could be either gaining from or losing out from either decision. If you're comfortable with where you currently are or where you're comfortably renting where you are, then it might make more sense just to hold off and continue to build up that down payment. Or on the flip side of that, it might make more sense if you have a growing family or if your rent exceeds what you'd be paying in interest to then switch that over and look at purchasing a property. The one last thing I want to highlight today is that you're going to have additional costs when it comes to home ownership, which a lot of the time people don't consider. So for a condo or a townhome, you're going to have strata fees, and they can range from anywhere $250 a month to upwards of $500 a month in simple strata fees. You also need to consider that there's going to be utilities and there's going to be internet. Maybe you didn't have to pay for internet or Wi-Fi at your current rental location. So these are things that are going to add up over time that could add up to well over $1,000 a month of additional expenses that you weren't incurring while you were renting. So again, keep that in mind. Every situation is different. You need to make that decision for yourself if it is the best decision for you. So take the time to actually do your due diligence on this before jumping to any conclusions, before jumping into a decision that will affect you for the rest of your life ultimately. Thanks guys, we'll see you on the next one.